Welcome to the debate from GiltEdge.uk. Before we begin, this content is for informational purposes only and does not constitute financial advice. Always do your own research and consider seeking independent financial advice before making any investment decisions. Your capital is at risk. Today, The Guardian and The Optimizer go head-to-head on "Your emergency fund belongs in cash. 4.55% proves the critics wrong." Let's get into it.
Let me be blunt, your emergency fund exists for emergencies, and emergencies don't wait for markets to recover. With easy access accounts paying 4.55%, you're getting a perfectly respectable return for money that needs to be there the moment your boiler dies in January.
And while you're feeling safe with that 4.55%, a £15,000 cash emergency fund is costing you roughly £600 a year in missed returns compared to a global index tracker. Over a decade, that's £5,000 to £8,000 in real wealth you've just given away for peace of mind you probably didn't need.
Didn't need? Tell that to someone who lost their job in March 2020 when the FTSE was down 30%. If their emergency fund was invested, they'd have been selling at the worst possible moment.
That's the sequence of returns argument, and I'll grant you it's the strongest case for cash. But here's what nobody mentions: most people don't lose their job the same week markets crash. And even in 2020, markets recovered within 5 months.
5 months is a long time when you can't pay your mortgage. You're assuming people can just wait it out, but the whole point of an emergency fund is that you can't wait.
Which is exactly why credit cards are your real first line of defense. Most people have £5,000 to £10,000 in available credit. That buys you weeks, sometimes months, to liquidate investments at a time that actually makes sense.
You're seriously suggesting people rely on credit cards for emergencies? That's exactly the kind of advice that gets people into debt spirals. Credit card rates are 20% plus.
I'm suggesting they use the interest-free period strategically. You've got up to 56 days before a penny of interest accrues. Pay the emergency cost on the card, sell the investments, clear the balance. You never actually pay interest.
Unless your credit card company cuts your limit, which is exactly what happened to thousands of people during COVID. Lenders pull back credit precisely when you need it most.
Fair point on credit limits tightening in a crisis. But I'm not saying invest everything. Keep 1 month's expenses in cash, maybe £2,000 to £3,000, and invest the rest. A tiered approach captures most of the upside while keeping genuine instant access for the first hit.
Now you're moving the goalposts. Your article talks about investing the emergency fund, and suddenly we're back to keeping some in cash. That's because deep down you know the cash portion is non-negotiable.
I'm being pragmatic, not moving goalposts. The personal finance orthodoxy says keep 3 to 6 months in cash. That's £10,000 to £20,000 doing almost nothing. I'm saying 1 month in cash, the rest working harder. That's a massive difference in outcomes.
Almost nothing? 4.55% is not a consolation prize. In real terms, after inflation at around 3%, you're still growing your purchasing power. That's historically unusual. We should be grateful for it, not dismissing it.
But that's exactly the inflation argument nobody makes properly. At 4.55% nominal and 3% inflation, your real return is about 1.5%. Meanwhile, equities have delivered 5 to 7% real returns historically. Your emergency fund is technically growing, but it's growing at a fraction of what it could.
Could? That's doing a lot of heavy lifting. Equities deliver those returns on average, over decades. Your emergency fund isn't a decades-long investment, it's money you might need next Tuesday.
Statistically, most people don't touch their emergency fund for years at a time. If it just sits there for 3, 5, 7 years untouched, you've essentially held a long-term investment in a short-term vehicle for no reason.
And the one time you do need it, the fact that it was instantly available in full is worth every penny of foregone returns. You're optimizing for the average case when emergency funds exist for the worst case.
But you can optimize for both. A money market fund or short-duration bond fund gives you near-cash liquidity with better returns. It's not binary between a savings account and a volatile equity fund.
Money market funds aren't protected by the FSCS. Your savings account is guaranteed up to £85,000. When Northern Rock collapsed, people with cash in the bank were fine. Fund investors had to wait and hope.
That's a genuine advantage for cash, I'll concede. But FSCS protection matters most if you think your bank might fail, and we haven't had a UK bank failure in over 15 years. It's insurance against an extremely unlikely event.
Emergency funds are insurance against unlikely events, that's literally their purpose. You can't dismiss one unlikely risk while building your entire strategy around preparing for another.
Look, we actually agree on more than it seems. Keep a cash buffer, absolutely. But the standard advice of parking £15,000 in a savings account and never thinking about it again is lazy financial planning dressed up as prudence.
And telling people to invest their safety net because the maths look better on a spreadsheet is reckless advice dressed up as sophistication. When you actually need emergency money, the only number that matters is the full amount, available today, no questions asked.
My final point is simple, £600 a year in lost returns is real money, and a tiered strategy, 1 month cash, the rest in low volatility investments, captures most of that upside without meaningfully increasing your risk.
And mine is simpler, the best emergency fund is the one that's there in full when the worst day of your financial life arrives, and 4.55% in guaranteed, instant access cash is a perfectly good deal for that certainty.
The Guardian, The Optimizer, thank you both. What do you think? Let us know in the comments. Read both articles in full at gilt-edge.uk. Thanks for listening to the debate.